All right, great. Well, hi, everybody, and welcome to the Cyber Trading University Closing Bell. My name is Rollie White, and I am today's guest speaker. And I'm going to be speaking a little bit today about futures day trading. More specifically, I'm going to talk to you about the pros and cons of day trading the futures markets from my perspective. I'm going to share with you 3 skills that I think every trader must master. I'm going to share also with you some charting techniques that I believe might be able to give you an edge in the market. I'm going to give you my perspective on what I think are the best futures markets to trade. And I'm also going to share with you a couple of strategies for how you might want to trade a trending and sideways moving market. Now, just to give you a little bit of personal history here, I've been an active futures day trader since 2007. And I've hosted a daily live trading room since about May of 2010. Prior to this, I worked for Dresser Industries for 30 years in sales and marketing, and I retired a senior vice president of operations. And I'm not one of those guys that spent 20, 30 years in the pits. I'm like many people that are here in the room, in that I had another life. I retired and decided I wanted to do something else with my life, and I decided to settle and focus on day trading. At the present time, I'm the operations manager at Trading Pub, and I still host a live daily trading room for Infinity Futures. I live with my family and my children and my grandchildren here in Austin, Texas. Now, before I get started, I do need to give a personal disclaimer, and that is the information that I publish here is educational in nature and is designed to contribute to your overall understanding of how I use technical analysis to trade the financial markets. I'm in no way recommending the purchase, sale, or short sale of any securities, options, futures, or other instruments. I'm not a financial advisor, and I'm not a registered analyst. I do not offer my trading ideas as recommendations for you to simply copy. These trading ideas just represent my own opinions and are intended to demonstrate my style of short-term trading. I'm also in no way representing that similar results will be achieved by following my ideas. Trading futures involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources, as you may lose all or more of your initial investment. So let's get right into the pros and cons of day trading the futures markets, and I'd like to start out with the pros, or the things that I like about day trading the futures markets. The first thing were capital requirements, and they are relatively low. You can open an account with most introducing brokers for as little as $3,000 to $5,000. And this was attractive to me when I was looking to trade the markets, and I was making a decision as to do I want to trade stocks or other items, et cetera, and I was enamored of the fact that I could start trading with a relatively low balance. I also like the fact that the funds are in a margin account and that the leverage can be as high as 100 to 1. I also like the fact that I could trade stock indexes, currencies, interest rates, energy, metals, and other commodities. In other words, I had a diversified choice of offerings that I could trade when looking to day trade the futures markets. A couple other things that I think that are key. I like the fact that I could open and close a position within the same trading session. In other words, by definition, as a day trader, I'm not going to be carrying any overnight risk. And honestly, folks, I'm not sure how people do that, because I'm not sure I could go sleep at night knowing I had positions in the market. I think I'd be up every hour or so checking my statements or the charts to see how I was doing. But for me, day trading, no overnight risk. I also like the fact that day trading margins are significantly lower than overnight margins, because you don't have the risk. Once again, the margin requirement is lower, and that equates to the number of contracts you can trade. I also like the fact that many trades will only last a few minutes, and you can control the entry and the exits. In most cases, I would say on average, the intraday trading trades that I take in the futures markets last anywhere between 2 and 10 minutes, usually no longer than that. And for me, that's plenty. And I also like the fact that when I trade the futures markets, I'm really making a decision about what's happening, and I'm not trying to think about what may happen. In other words, since I'm not taking a buy and hold position in the market, I'm just reacting to what's going on in the current time. I also like the fact that there's more reliance on technical analysis with fundamentals typically priced in. When I was first looking at trading coming out of the corporate world, I immediately started looking at stocks and I was like, oh my gosh, I'm going to have to read annual reports and 10Ks and sector analysis and things of this nature. And when I came to the conclusion that there's lots of ways to trade the markets, including trading an index, and what technical analysis was and how to apply it, it really appealed to me because once again, as a day trader, I'm not really worried about what the market might do down the road. I'm worried about what it's doing right now, and technical analysis can assist in that regard. I like the fact that I could use trade management techniques to minimize risk and manage and maximize profits. In other words, I like the fact that when I got into the market, I automatically knew what my profit target and my stop loss was. I also like the fact that I could establish a short position as easily as entering into a long position. So in other words, if the market was trending short, I would have no problem taking a short position equally as well as taking a long position if the market was trending higher. And I also like the fact that commissions were relatively low, somewhere between $4 and $8 round trip per contract, and that depends on the market. If I'm trading the E-mini S&P or the 30-year bonds, for example, it's closer to $4 round trip. If I'm trading gold or crude oil or something along those lines, it could be closer to $8 round trip. But relatively speaking, from my perspective, a low commission amount. Now let's take a look at some of the cons or things that I didn't like or I was concerned about day trading the futures markets. One of the things that you need to know about this is that if you don't know what you're doing, you can lose money fast. And I think that's probably true when you're looking to trade or risk any kind of capital, but when you're dealing with a market that's as heavily leveraged as the futures are, this situation is just magnified. So leverage can work for you, but it can also work against you and in a hurry. I also found that quick wins can lead to overtrading and false confidence. In other words, I mentioned earlier that some of the trades that you get involved with when you day trade futures may only last a minute or less. And you can have several nice little winning trades in a row, and it can give you a feeling of empowerment, of invincibility, and the fact that, hey, I want more action, I'm going to take more trades, and overtrading is something that really works against most traders. I also was concerned about the fact that emotions can quickly get the better of you and can cloud your rational thought. In other words, when you combine the fact that the markets are moving fast with leverage, emotions like fear and greed can quickly come to the surface and can interfere with your ability to logically trade the market. And for me, that was a concern. And then lastly, constantly turning over strategies in search of the Holy Grail. When you're trading leverage markets, the potential for gains is such that we're all looking for those strategies, if you will, constantly looking for strategies that are going to give us an incredibly high winning percentage and also with a risk-reward ratio that's significantly in our favor. And if we are working with something and we have a few losing trades, it's so easy just to kind of throw that out and then look for the next idea. And once again, to me, I think that's something that's systemic to day trading the futures markets and something to be aware of. But when I balance out the pros and the cons, from my perspective, the pros outweighed the cons. And more importantly, the best advice I was ever given as I started down the path to day trading the futures markets was that 90% of what it takes to be consistent as a day trader would be on my ability to control my emotions. And you just think about that for a minute. I'm sitting there going like, wait a minute. You've got these markets, you've got these capabilities, I'm doing all this studying, I've got these strategies. When I ask the question, what's the one thing that I can do to improve my consistency? And somebody says, control your emotions. I'm like, sure, I can control my emotions. If there's one thing I can control, it's my emotions. And so if you're telling me that that's all it takes, then I'm all over that. And we know as human beings, we operate 70% on emotion. And from that perspective, that's one of the things that's a difficult thing. This is probably a topic for another presentation, but I just thought I would share with you what I considered significant advice was a big takeaway for me as I embarked, down the path of becoming a day trader. Now, I mentioned earlier that I wanted to share with you 3 skills that I think every trader must master. And I mean, this is going to sound like an oversimplification, but I don't think it is any more basic than this. And that is, number 1, you have to be able to determine the direction that the market is moving in. You have to be able to look at the market and know, is it moving up, or is it moving down, or is it moving sideways? And I know that sounds simple, but you'd be surprised how many people really struggle truly understanding the direction that the market is moving in. Because once you understand which direction the market is moving in, then you move to step number 2, which is to select the best strategy for the direction the market is headed. So if the market is trending, for example, if it's going up or if it's going down, you want to make sure that you're looking to deploy a trend following strategy. And if the market is moving sideways, you want to make sure that you're using a trend fading or a scalping strategy for these sideways moving markets. Now, I know a lot of traders out there that basically will have their favorite strategies. And let's say, for example, it's a trending strategy. And one of the biggest mistakes that they make is to try to apply that strategy when the market's moving sideways and they didn't even recognize that the market was moving sideways. Or if you're taking a scalping strategy where you're looking to take a quick nibble out of the market, you don't recognize that the market is actually trending. So this is step number 2, recognize the direction that the market is moving in. And then the third thing is to use trade management to minimize risk and to maximize your gain. To understand, once you know the direction that the market is moving in and you've selected the correct strategy, what is the correct entry? What is that high probability setup? And then entering the market with a predefined profit target and stop loss so that you can remove emotion from the equation once you've entered in the market and you've got your fill. And for me, this is not just futures trading. I think this applies across the board. But since my expertise and all my knowledge is in futures trading, these are 3 things that every trader has got to master and must master in order to be consistent trading the markets. So the next thing I start to think about a little bit about is, are there some charting techniques out there that can give you an edge? And I really do believe that there are. Because once again, now we're talking about how am I going to understand the direction the market is moving in. So that's thing number 1. What kind of things can my chart do for me, or indicators or things to help me understand the direction? Because that's step 1. Well, if we look at the choices that are generally available, the most popular charting method is a time-based chart. 60 minutes, 30-minute chart, 15, 5-minute, 1-minute charts. But once again, I'm primarily talking about day trading at this point in time. And this is the most popular way, the way most traders trade the markets. A little less popular would be volume-based charts, where each bar will form based on a predetermined number of contracts that is traded. This has a little bit more emphasis on volume. And then there's the little-known, little-practiced price volatility charts like range bar, momentum, breakout, even point and figure charts. And these are charts where your bars actually move associated with price movement and independent from time and volume. And from my perspective, as I traveled down the path of time-based charts, the volume-based charts, the price volatility, I think the edge is here with price volatility charts. Let me give you an example here. Right here, we're looking at the gold market, and this was back on the 8th of July, just a few days ago. And this blue line here is the open of the U.S. trading session, so this would be 9:30 a.m., and this blue line here is the close of after the close of the first 2 hours. So this is the first 2 hours of the trading session at 10:30. Now, gold was moving along kind of sideways here, and then boom, what a downdraft here. Now, looking at this 5-minute chart, how do you take advantage of this short move on this chart? The move was actually in this section right here. If you enter short at this point in time, you run a real risk of chasing the market, and you're sitting there going like, man, the market's already moved. How do I take advantage of this? So for me, when I look at time-based chart, what I see are chop and missed opportunities from my experience. Conversely, let's take a look at what a 20-tick range bar chart looks like. This is this same time increment, but on this chart, each one of these bars is exactly 20 ticks long. And as the market started to move lower, we saw 1 bar, 2nd bar, 3rd bar, 4th bar, 5th bar, 6th bar. I dare say when you're looking at this kind of a chart going short like this, knowing that this is the direction that the market is moving in, you have an easier opportunity to see and spot a chance to get into the market short and to take advantage of this move compared to what you might see on a time-based chart. And for that reason, I believe that this is the best choice. I think this gives an edge. And let me talk about this a little bit further. When you look at a range bar chart, the market entries are based on price movement and independent of time and volume. So we really don't care about time and volume. As a matter of fact, many traders will say the only thing I care about is price movement. Well, if that's the case, then a price movement chart or a price volatility chart is where your focus should be. We know that each bar is exactly the same length. And so it's easy to see when a new bar is going to start and stop because there's no question that the bar is going to be 20 ticks long, so the next bar has to open here. And there are tools and little software programs that help you identify that even easier. It also eliminates a lot of noise and makes it easier to look at market direction because we know over time or with volume, you're going to have spikes and things of that nature, which will give you longer bars, shorter bars, etc. But once again, just to your eye, you can see that this is a very gradual slope and a move in this market going lower. It also better supports the use of limit orders for more precise entries. And I think this is key. As opposed to looking to time a market order to get in at the beginning of a time-based bar or a volume-based bar where you have the potential of slippage, as the market is moving lower or moving higher and you know when a bar is going to open next, you have plenty of time to place a limit order in the market. And what you're basically defining at that point is when you are prepared to enter the market. When you want to engage, you're making the decision, this is where I want to enter. So once again, this gets back into stripping away the motion and taking control of what's going on. It also, I believe, gives you an edge since less than 10% of traders use price volatility. And by the way, folks, there's no report on this. I've just talked to several trading mentors, people that work with students on a one-on-one basis to provide them. And I've heard it as low as 5 to 2% of the people that they run into are even aware of range bars and how to use volatility pricing to trade. So once again, the edge here is that when you're trading with range bars, your orders appear at random intervals, making it easier for potential fills. And what do I mean by that? Let's say, this is a gross example, but let's say the whole world was trading on 15-minute bars. That means that every 15 minutes, there's a ton of orders that are going to be coming into the market. Well, when you're trading, when you realize that a lot of people are trading on 5-minute bars, 10-minute bars, 15-minute bars, things of that nature, you are going to see activity spikes around those time frames. But if I'm just looking, for example, at price movement and some patterns are helping me understand where to enter the market, then I've got some randomness when I'm entering into the market, and I have found that this gives me potentially easier fills, and that combined with the ability to see maybe a better view as to what's going on in the market does in fact combine to give you an edge. So now things get a little bit stickier because now, once again, if we just follow along with me, that, you look at the range bars, and the next thing is like which indicators are good to use. And, indicators, generally speaking, are all designed or intended to assist us to predict a future event. Yes, most of these are lagging, if not all of them are lagging indicators, but they're all designed to give us some predictive value as to what could occur. And there are many types of indicators out there, ranging from oscillators to moving averages and everything in between. But for me, when I took a look at all that stuff, I decided I just really want to keep things simple, and I only want to pay attention to indicators that help me with market direction. I just need to know the direction that the market is moving in. And from that perspective, there are 3 indicators that I find that are most helpful in doing that. Bollinger Bands help me see the direction that the market is moving in very clearly. The MACD, the moving average divergence, confirms for me if the market is in a bullish or bearish condition. And then the relative strength index, the RSI, shows me the relative strength of a market move. And I'm going to be showing all these things on the charts in just a little bit. But for me, the combination of these 3 things, along with my ability just to see what's going on in the chart, is what gives me a pretty good sense as to the direction that the market is moving in. In addition, I always like to keep an eye on areas of major support and resistance, in particularly the previous and current days, high and low, and the main pivot point, resistance 2 pivot point, and support 2 pivot point. And this become a little bit evident later on down the road, but support and resistance are key areas to pay attention to, because if you're looking to enter a trade or you're in a trade and you're approaching these areas, we know that the market is going to take on a slightly different personality as prices approach these areas. We'll talk about that in just a few moments. So from this perspective, let's go right to the charts and see what this all looks like. And so what I've done here, folks, what you can see here is that this is the E-mini S&P 500. And today is the 15th, so this is kind of right where we were prior to the open of today's session. What you're seeing is a series of open, high, low, close bars, okay? And these are 8-tick range bars. So each one of these bars is exactly 8 ticks long. So from this perspective, I'm looking at the market, and I already see some things that are going on. Not hard to see that the market's going up or it's moving sideways, etc. But it's really rather bland, and I'm not sure it gives me all the information that I'm looking for. So the first thing I'd like to do on this thing is let's go ahead and add the Bollinger Bands. So the first thing I've added is the upper Bollinger Band, which is this green line. And now I'm going to add the lower Bollinger Band, which is this red line. Now, looking at the Bollinger Bands at this point in time, they're helpful to me because if the Bollinger Bands are pointing up at a 45-degree angle or more, and they are leading prices, I mean prices are inside the band, not piercing through them, but they're leading the prices up, this is a strong indication to me that this market is moving high. Conversely, if the bands, are pushing down at a 45-degree or more angle and they're leading prices lower, the markets are moving lower. And if the bands are moving sideways, as we see right here, that means the market's moving sideways. Forget what the bars are doing inside the bands, which is where a lot of mistakes are made. Somebody here could think, oh my gosh, the market's going long, but the bands are moving sideways. It's not indicating that the market is trending long. So that's indicator number one, the Bollinger Bands. The next indicator that I'd like to add to the chart is the MACD, because the MACD is going to help me understand if the market's in a bearish or bullish condition. So you can see the MACD here at the bottom. We see a histogram, and we see the MACD and the moving average, etc. This is interesting to me, but what's more interesting is what you do with it. The first thing we do with the MACD is that if the MACD is above the moving average and above the zero line, I say, let's paint the lines green. Let's paint the bars green. So now visually, every time I see a green bar here on the chart, that tells me that the MACD is above the zero line and above the signal line and in a bullish condition. Now let's go ahead and paint the bars red if the MACD is below the signal line and below the zero line. So now we have red bars. So all I'm looking at is I see a red bar and I go, woo, the market's in a bearish condition. Why? Because the MACD is below the zero line and below the signal line. And everywhere I see a black bar tells me that the market is in transition. It's neither bearish or bullish. It could be transitioning from bullish to bearish, or it could be just moving sideways for a bit and fall, but it's in a transition period. Any way you look at it, since our eyes are always here on the right-hand corner, because this is where the price action is, the more I can put right here, the easier it is for me to make a decision as to what's going on. Okay? The next thing that's important to me is the relative strength index, because I want to know if there's good strength behind a move. And so at this point in time, I add the RSI to the chart here at the bottom. But the RSI, this chart down here that we see here, what it does also is I've programmed it to go ahead and tell me some things right on the chart. If I see a green triangle underneath the bar, that tells me that the RSI is above 70. So when I see the Bollinger Bands pointing up, which means the market's trending higher, and a green bar that tells me that the market's in a bullish condition, and a green triangle telling me that the RSI is above 70, this is the kind of confirmation that I'm looking to see that the market is moving longer. So now there's no question in my mind. I know the direction the market's going in. It's trending higher. Now, if you see a red triangle on the chart like we see right here, this means that the RSI is below 30. So I don't even have to look down here. All I got to look right here, and I can see that the RSI is below 30. And now I see the Bollinger Bands are leading prices lower. I've got a red bar indicating that the market's in a bearish condition, and I've got a red triangle telling me that there's strength behind this move. So these three indicators by themselves are really the only things that I need to tell me if the markets are going up, down, or sideways. And since we know that's the first thing that must be mastered, it's not an automatic, but I find this an extremely helpful tool in determining how to trade the markets. Now, there's a few other things that we have to add to the chart right now to complete this picture. The next thing, remember I talked about support and resistance levels? Well, I'd like to add the pivot point. Okay, the pivot point is a popular area of support and resistance. It's based on looking at the prior day's high, plus the prior day's low, plus the prior day's close divided by 3, and it's a key area that all traders are aware of, and because of that, it is a self-fulfilling prophecy. It is the main pivot point. I also like to plot the resistance to pivot point and the support to pivot point. You can see it down here in gold. So these are some key areas of support and resistance. If you remember, I also said that it's important to me to see the previous day's high and the previous day's low. So by adding the previous day's high, which is this green dotted line, the previous day's low, what I've done at this point in time is I've gone ahead and added, if you will, the key things or everything that I need to know on this chart to be able to trade the markets. There are a couple of other things that I'd like to add to this. For me, for example, my favorite time to trade is in the first 2 hours of the trading session. That would be from 9:30 Eastern to 11:30 Eastern. So I go over here to my charts and I say, hey, why don't you just give me my trading time? Boom. And you see this light little orange, yellow area back here? That just makes it easier for me to see. I know that whenever I'm trading on a yellow background, I'm trading during my preferred time for trading the markets. And collectively, these are the things that I believe could give you an edge in the market when it comes to starting out with your basic charting. So at this point in time, what have we done? We've talked about the fact that we need to understand the direction the market is moving in. We've basically said, okay, is there a charting setup that I can use that might give me an edge there? And I've recommended that range bar settings are an excellent way to do that. We've also asked, are there some indicators that can help us a little bit? And I said, yeah, I think there's 3 of them, the Bollinger Bands, the MACD, and the RSI. And then I've also added some support and resistance lines that will help me make some trading decisions down the road. So let me go back to our presentation here, and let's start to look at a couple other factors. When it comes to what are the best markets for day trading, as I mentioned earlier, there are a lot of choices for you out there. Once again, it's one of those opportunities where you can be trading currencies, you can trade agricultural products, you can trade soft products. Heck, you can even trade futures on the weather if you want to. But from my perspective in looking at things, what I tend to focus on are those markets that have volume and volatility, because those are the things we need to see primarily if we're looking to day trade the markets. So from that perspective, I break things down into a couple of categories. I have a lot of people will ask me, hey, Rollie, I'm new to trading. I'm a newbie. Can you recommend a market that I should trade as a newbie? Definition of a newbie is somebody who's brand new to trading the futures market, and they might have a small account size somewhere between 3,000 and 7,000. And by the way, as a new trader, you don't need any more than that, because you're not going to ever really be putting any more than 2 to 3% of 2 to 5% of this at risk at any given time. I know when I first went to open up my account, I was prepared to put $50,000 in there. My broker said, why? You're only going to be trading or risking $200 to $100 on every trade. You may as well just, put 10 grand in there and put the other 40K in an account to go ahead and and get some interest on it. So there's a question from a trader real quickly here. He says, what about the $25,000 minimum for day trading? That's day trading stocks. So if you're a frequent day trader of stocks, you need to have the $25,000 minimum. But if you are day trading the futures markets, once again, you can open an account and trade with as little as $3,000 Between 3,000 and 7,000, I advise most people to look around 5,000. So the three markets that I recommend, once again, folks, subjective here from my perspective. There could be a lot of views on this, but if you look at the E-mini Dow and the E-mini NASDAQ, both of these markets, when they move a tick, you're looking at a $5 move. So it's not that expensive a move. And to diversify a little bit, 10-year notes, where they move in half ticks, and each tick moves $15.63. Now, the reason why I recommend these for people that are just getting started is because the strategies that I'm talking about, that if you want to learn them, you can apply them to these markets, and they work equally well in some of the other markets I'm going to talk to you about. So, honing your chops on these markets is not going to hurt you when you go to trade some other markets, number one. Number two, when you're only risking, $5 per tick, or let's say you're going into a trade and you're only looking to make 4 ticks, which is $20, and you're only going to be risking $20 or $30, this is a way for you to get into the waiting pool before you work yourself into the deep end. So from that standpoint, to the extent that every trader is going to have to transition from trading paper money on a simulated account to trading live, it's nice to know that there's a little interim step there so that you can get your emotions under control, trading live money. I put it this way. I just learned how to play poker. I want to play live. I don't want to play with the sharks. How about a game where I'm playing penny, nickel, dime? Okay, I'm still going to have to apply everything that I know about poker to play, but my risk isn't all that great, and I'm dealing with the first time of risking real capital. This is what I consider this to be, is just a place to get started. Now, for those intermediate day traders or those with a medium-sized account, somewhere between $7,000 and $10,000, I think you could take a look at the E-mini S&P 500, the most liquid of the markets and highest volume that's being traded. One tick move is worth $12.50. You can look at the 30-year bonds market, where one tick move is $31.25, and the Euro FX futures, the 6E market, which is where one tick is $12.50. Now, once again, when I talk about the Euro FX futures, this is not over-the-counter Forex. This is trading the futures markets through the Chicago Mercantile Exchange. So it's a great way to trade futures without, with the transparency associated with trading through an exchange. And then lastly, for advanced day traders with large accounts, 10 to 20,000, you can look at adding oil and gold in the E-mini Russell. There's other products that could be added, folks. I haven't even talked about the agricultural products like wheat and corn and soybeans, etc., but I put them in a special category. But as far as it comes to a base number of markets, these 9 markets here at this point in time are a great foundation, along with the strategies and the techniques I'm about to share with you that have the potential, for example, to make it interesting for you as an intraday trader. Once again, caveat here, these are just my opinions. Some people would argue and say, oh, the E-mini S&P, you can do that up here, and E-mini NASDAQs, you can just go on and on. Just take it for what it's worth. This is my recommendation based on my experience and my background. So what do I trade on a daily basis? Okay, on a daily basis, I trade the following 6 markets: the E-mini S&P 500, the E-mini Dow, the 30-year Treasury bonds, the Euro FX futures, the gold market, and the crude oil market. So here are the symbols for those markets, and then here are the range bar settings for each one of those markets. Because each market has a different profile and has a different price movement characteristic to it, there's not one universal tick setting for the range bar. You look at each market independently. Here are the current contract months that I'm currently trading. And once again, I day trade every morning, and as I mentioned a little bit earlier, I moderate a live day trading room for Infinity Futures. So let's now take a look at some strategies. Now, remember I mentioned to you earlier that we have to basically understand first, is the market moving up, down, or sideways, and then we need to select the appropriate strategy. So in this particular case, what we're looking for is we're looking for a trend. We have a trending market condition and we're looking for a trend following strategy. We all remember the trend is your friend. Well, what is that trend following strategy? We're looking at a strategy that has about a 1 to 1.5 risk reward ratio. What that means is that you're risking $1 to make $1.50, or you're risking $2 to make $3. The target winning percentage with this strategy is right about 50%. And some people go, 50%? That's not very good. Well, you know, if you're batting 50% and for every $2 you lose, you're making $3. If you're a 50% winning percentage, you make money all day long with this strategy. Now, your profit target on this kind of a strategy is 15% of the average daily range. And I'll talk about that in a minute when we take a look at the real charts. But generally speaking, each market has an average daily range that's calculated. 15% of it, you're looking for a 15% move. That's your defined definition as to what the move is 15%. That's your profit target, and your stop loss is 10% of that average daily range. So if we take a look at the gold market, for example, okay, what we're looking for here is the first bar with a green marker at the RSI above 70. Okay, so we see a green bar here, and here's the first green bar with the RSI above 70. So my entry point, this is a nice thing about range bars. I already know that my entry point is 1321.7. Okay, I also wanted to see here that the Bollinger Bands are leading the prices higher, as we can see they are at a 45-degree angle. And I want to place a buy stop order one tick above the range bar if it's below the Bollinger Band. So once again, this is the bar that closes, and this is the entry. The entry is inside the Bollinger Band. The Bollinger Band's pointing up. The bar is green. It's bullish. And we have the green indicator. And on this particular case, we're entering with a 30-tick profit and a 20-tick stop loss. In gold and crude, each tick is worth $10. So for every contract traded, this is a $300 profit target, and this is a $200 stop loss. So once again, whether it's gold or crude or the E-mini S&P or the bonds, this is what you're looking for. Bollinger Band leading prices higher, bullish condition. I'm not being interfered with by major support and resistance. As a matter of fact, prices just cleared the previous day's high. Great place to enter up here. And my profit target's just underneath another area of resistance here. So nice move there. Let's take a look at a short entry. In a short entry, what we're looking for is the first red bar with a red marker, meaning that the RSI actually is below 30 is what this should say. I have to amend the slide, below 30. So we see we have a red bar here. Now we have a red bar with the RSI marker here saying that the RSI is below 30. The Bollinger Bands are pointing down. The red bar tells me I'm bullish. The RSI tells me that there's strong strength here. I open at the beginning of the next bar, following the close of this bar, and I enter at 106.86, and I get out at 102.56. This happens to be crude oil, and each move in crude oil, tick in crude oil, is worth $10. And so a 30-tick move here is a $300 move, and my stop loss here is a 20-tick stop loss, or $200. So I'm risking $200 to make $300 on this particular trade. And folks, once again, I could go through example after example after example, but these are the two things that you commit to your mind's eye that you want to see from a pattern perspective when determining, is the market in a trending condition? And if so, what's the strategy to use? This is the trend following strategy. So now let's shift around and take a look at strategies for a sideways moving market. Now, in this particular case, when we're scalping the market, the risk to reward ratio is going to scare you initially. We're going to risk $4 to make $1. In other words, the markets are moving sideways. I'm looking for a little quick win, and I have to be prepared to give it some room to move in order to be successful. But the key thing here is the target on this strategy has got to be 80% plus in order for it to make any sense for you. Now, your profit target is 25% of the length of the bar, and your stop loss is 100% of the length of the bar. So we have a situation, for example, and the filter, what we're looking for is this thing called a 2-bar pullback. I'm giving you a lot of information. I'm going to shortly go to some charts, and we're going to go through it bar by bar, and you'll be able to visualize this a little bit better. But looking at this long entry, what I'm looking for is that the Bollinger Bands are either flat and or the market is showing a long side bias. Well, right now we see that the Bollinger Bands are going up and they're flattening out. Okay, so we're starting to see this flattening situation here. The next thing I look for is 2 or more bars closing higher, followed by 2 bars closing lower. So here I see 1, 2, 3 bars moving higher, 1 bar retracing, and a second bar retracing. What this does is that this gives me a long entry signal right here at 16,869, and I'm only on this particular trade looking, this is the E-mini Dow, I'm only looking for a 4-tick move here. Why 4 ticks? Because the range bar on the E-mini Dow is 16 ticks long. My profit target is 25% of that. And so I'm only looking for a quick 4-tick move. So let me just rehash here. These 3 bars moving consecutively higher told me I had a little mini trend going long. These 2 bars retracing gave me an entry opportunity here, with the idea being that following the retracement, there may be a small move back in the direction of the mini trend. Long, retrace, move a little bit higher. I'm not looking for a big move. I'm just looking for a quick scalp in a sideways moving market. Now let's take a look at a short entry. In this particular case, we're looking at the E-mini S&P. Are the Bollinger Bands flat and or the market is showing a short side bias? At this point in time, the Bollinger Bands are pushing lower, so we have a short side bias. So I'm going to be trading in the direction of the bias of the market. I need to see 2 or more bars closing lower, followed by 2 bars closing higher. So I got 1, 2, 3 bars going lower, 1 bar retracing, second bar retracing. My short entry is right here at 1959.75. Since this is only an 8-tick range bar in the E-mini S&P, 25% equals 2 ticks. So I'm only looking for a 2-tick profit, and I have an 8-tick stop loss up here, and the market comes and gives me my 2 ticks. The market initially was pushing down, it retraced, and I'm looking for a scalp. Now, scalping the markets can be a very, very difficult way to trade the markets. I mean, that's a way to grind out stuff, but there are times, like most of the time, 70 to 80% of the time these days, when the markets are only moving sideways. And so if you are just armed, if you will, with a strategy for trending, when the markets mostly move sideways, then you're going to be sitting on your hands an awful lot, or you're going to be getting chopped up as you make mistakes in the market. Now, what I want to do here is try to bring this all together by coming back to our charts. Now, I mentioned here on this chart that we were coming right into the open of today's session, and I just want to go through this kind of bar by bar. Okay, now you can see this is this morning. This is 9:30 Eastern time. We see that the market's moving up. Okay, at this point in time, you know, this was giving us kind of a long entry signal, but right at the open, I don't recommend anybody look for a trending condition in the market. What I'm looking for primarily in the first 30 minutes of the trading session is a scalping entry. So you can see I have 2 bars going up. I have 1 bar retracing. Now I have a second bar retracing, okay? This is a 2-bar pullback, and what this is doing for me, it's telling me that there's an opportunity to take a long entry in the market. This bar closed at 1973.25. I get in at the beginning of the next bar, which is at 1973. Now, in this particular case, I'm here at 1973. My stop loss is 8 ticks or 2 points, which is down here to 1971. Scary proposition. I got filled. The market comes within 1 tick of stopping me out, but comes back and gives me what I'm looking for, which is only 2 ticks at 73.50. Remember, this is the E-mini S&P, only looking for 2 ticks. So in this particular case, I picked up $25 per contract traded. So let's continue to look. Now you see I have 2 bars down. I have 2 bars moving up. The RSI is not favorable to me. So let's go here. And the market's just kind of chopping sideways now. Today was very, very interesting because can anybody tell me what happened right here at 9 o'clock? Well, I'll save you the drama, but we had Janet Yellen before the Senate Banking Committee, and you can see the markets got very, very sideways, and then she started giving her presentation, and then the Q&A session happened, and the markets really started to get very, very volatile. We see the markets are selling off and then they're bouncing around a little bit. At this point in time, I don't see anything to trade. But right here, what is this? This looks like a nice opportunity to enter the market short, right? Trending trade, Bollinger Band pointing down, first red bar, RSI indicator confirming that. And so my entry signal, it's already calculated for me here. I'm just going to be sitting here at 66.75. So getting in at this point, I know, let me put a couple other things on here. I know that my profit target on this is 3 points. So that's going to be at 63.75 as my profit target. And I also know that my stop loss is 2 points, and that's going to be at 68.75 right here. So let's see what happens. Okay, the market pushes down, and it pushes down a little bit further. Now, one of the things that I also know about trading, and you can see it just pushed all the way through here. I was going to share something else with you just for a minute, but this trade went all the way into its profit target. So 3 points, each point is worth $50. This was worth $150 per contract traded. But the thing that I wanted to mention to you is that when you are in a trending trade or in any kind of a trade, once the market moves 2/3 of the way in your direction, or in this case, when it went to 64.75, at that point in time, that's a great place to move your stops to break even. Maybe break even plus a tick to lock in commission. There's no sense in letting a trade go 2/3, 3/4 of the way in your direction and turn right around and knock you out. You've got to get something out of the trade. And so from that perspective, that's a little trade management that would have occurred. Remember, that was the third thing that I mentioned. You have to have the direction of the market that's moving in, select the right strategy, and then have good trade management. I knew my entry. I had my auto, my stop loss, my profit target, but I also knew that if the market moved 3/4, 2/3 of the way in my direction, I was going to move my stop losses to break even. So let's continue to see what goes on here in the market. You see the market, okay, I've got a 2-bar retracement here. We've got 1, 2, 3 bars moving lower, 1 bar retracing, a 2nd bar retracing. I've got an opportunity to take a scalping entry short here at right here at 1966. And in this case, you can see the market came here. My profit target was there at 50, and I was tagged at my profit target, and my stop loss is sitting here at 64. Let's put 64 right here. And you can see at this point in time, I came within a tick, and then the market moved up and would have filled me. So if I didn't get filled here, and that's hard to say, when the market moves right to your profit target, you don't always get a fill, but it came down within a tick and then it moved, and this would have been a nice little scalp, although very, very close to being knocked out. As we continue to watch, this is the close of the trading session. So this was 2 hours, and you can see the trading activity that occurred here. From my perspective, all I was doing was watching the direction the market was moving in and then selecting what I felt was the most appropriate strategy for what was going in, and then entering with very defined entry signals and also profit target and stop losses. So if you'd like to, we can take a look at, let's take a look at another market. Let's take a look at what gold did today. Looking at the gold market, this is right before the open of the U.S. trading session this morning. So this is prior to 9:30 Eastern time. So we can see here the market is open. We have 2 bars going down, 1 bar retracing, a 2nd bar retracing. And what this does is this gives me an entry signal. Let me see where the entry signal is, right here. And on this particular trade, I'm looking for 5 ticks. Remember, the length of the bar in gold is 20 ticks. So 25% of that is 5 ticks. So 5 ticks puts me right here at 1310.6. And you can see the market filled and came down and would have filled me, giving me that profit target, because it actually came down to 1310.5. So a quick little scalping entry right here was successful. That's 5 ticks or $50 per contract traded. Just barely, but barely counts. So let's go ahead and see what else happens. Now we see we have 1, 2, 3 bars moving up, 2 bars retracing. There's another long entry opportunity to scalp the markets here at 1309.6. Once again, look at the Bollinger Band, sideways. This market's moving sideways. And I got my fill at 6. All I'm looking for is 5 ticks up here to 1310.1. Let's continue to watch what's going on. And by the way, the market really gets strange right here. You'll see what I mean. If we came down here, well, I see strange. This bar should have closed up here, but we started to see some real volatility as Yellen was speaking. All of a sudden, gold dropped. It fell through the floor, and I'll show you what we're talking about. At this point in time, look at the big distance here. This means that gold prices are moving faster than even the charting software can catch up with it. But the entry signal opportunity here to go short on this trending trade is right here at 133.05. Now, looking at this trade, and let me go ahead and move my bar up a little bit more here. The profit target on this particular trade would be sitting here at 30.05. So let me go ahead and put this in here. Now, I'm not sure how many of you all would recognize this, but this red line that's sitting right here, that's the previous day's low. And for me, in the moment right now, I never want to enter a trade where my profit target's on the opposite side of major support and resistance. I don't want to have to fight through this area to get to my profit target, because I fully expect prices to come here and pause and maybe bounce back in this direction. So from a discretionary standpoint, even though it's a technical entry signal, I would have stood by the wayside on this particular trade. So we continue to go on, and we can see it pushed on down. It would have been a profitable trade, but I didn't know that right here. And this is where gold just really kind of fell off today. So I want to show you one last market before we wrap things up. I see I have about 7 more minutes to go. Let's take a look at crude oil. Now, crude oil moved a ton today. For anybody that was watching crude oil, it actually moved below $100 a barrel. And let's go ahead and take a look at crude. Now, crude was already trending lower coming into the market. So I know that as the market comes to open right now, I'm not going to jump in on a short trade. This market it's already moved. There's no way that I want to sell a bottom potentially. I have no idea what crude's going to do, but the entry signal was up here. But I only trade crude or any of my markets in the first 2 hours of the trading session. I'm asleep at this point in time. This is the middle of the night. So at this point, I really have to wait for this market to retrace. So I'm looking maybe for a scalping entry, because I'm just not going to see any kind of a trending entry that I'm aware of. So the first bar opens up and we see this retracement. I'm going, hey, maybe the next bar will close higher. No, it didn't. It started to close higher, closed lower. No scalping entry. Next market moves lower, bar lower. This one moves higher, and I'm going, hey, maybe I can get a short entry right here. No, moves lower. Moves lower, moves lower, moves lower, moves lower, moves lower, moves lower. Okay, now I see it retrace, and I'm going like, hey, I might be able to see a 2-bar pullback here. No. Still in a downward trend, no scalping. The only reason I wanted to show this was here's a market that when I look back in hindsight, I say to myself, how in the heck could you not have taken something out of this move lower? But if you go back and look at it in the moment, it was already trending coming into the market. I didn't want to sell at the bottom because this market could easily bounce back up in this direction. I sat there waiting for a 2-bar pullback or retracement, and it never happened. But at least I was in charge of my discipline. I was determining how and when I wanted to get in the market. And so from that perspective, once again, I was in control of all these trades. And if you remember, it really boils down to those few things that I was talking about. So in my opinion, I think day trading the futures markets has good potential. You're in control. You're not in any overnight positions, and it has relatively low account requirements. I like the fact that there's diversity in the markets that you can trade, and this is different. And you can, from stock indexes to commodities. You saw that I was trading stock indexes. I had a currency, the Euro FX futures. I had an interest rate in the 30-year bonds, and I had gold and crude. Typically, between those 6 markets, one or more of them are going to be moving or doing something during the first couple of hours that gives me an opportunity to trade. They are highly leveraged, and there are reasonable margin requirements and low commission. So once again, the highly leveraged part doesn't bother me. It would bother me if I didn't know what I was doing, but the highly leveraged part means that with a relatively low amount of capital, I'm controlling a big position in the market, and I should be able to make, some comfortable money trading the markets doing that way. But the risk is high. The risk is extremely high, and if you don't know what you're doing, you could lose all or more of your initial investment. These two statements have to be made in conjunction with one another. But like with anything else, though, in life, you've got to try before you buy. If any of what I shared with you today makes sense or is attractive to you, get a hold of a demo charting software and a practice account in the futures markets. And arrange to get access to real-time data feeds, not 10-minute delay. You want to, there's a purpose for historically trading the markets, and then there's that point in time when you want to sim trade in the live markets. So just make sure you've got real-time data feeds that are not on a 10-minute delay. You also want to make sure that you get a conservative simulator to place your trades. And what I mean by that is you don't want a simulator that fills you as soon as prices touch your entry or your exit, because that's unrealistic. I can't tell you how many times I've run into people that just felt like world beaters trading the markets on a simulator, because every time prices touched their entry, they had an instant fill, and every time it touched their profit target, they were out instantly, only to start trading live to find out that that does not happen. There is such a thing as FIFO, first in and first out. And depending where you are in the market, and are you going to get slippage or not slippage, and if you're using limit orders, this could be a real eye-opener. So make sure that you've got a conservative simulator. What you need to do is find a trend following and a scalping strategy that you like. I believe you have to at least have two strategies, because the markets are either moving up, down, or sideways. And as I mentioned to you, these days, the markets seem to be somewhat range-bound, and they tend to be moving sideways more often than not. I think you need to log at least 40 trades per strategy and to build a statistical base for yourself. In other words, you have to prove to yourself that you understand the strategy and how to use it, and don't trust anybody else's results. Just because I can do something doesn't mean you can do it. So if you do 40 trades per strategy per market, and you log each one of those trades, the wins, the losses, the drawdowns, etc., you will know, statistically speaking, after 40 trades, if you understand the strategy and if you can apply it in a consistent way in a particular market. And then, want to wrap everything else, only risk real capital when you are confident in what you're doing. If you can achieve these steps right here, you can make that move, and not just for futures, for any markets that you're looking at trading. So looking at my clock here, I think I've done a great time with clock management. We have about 2 minutes left to go. My disclaimer, once again, trading futures involves substantial risk of loss, and it's not suitable for all investors. You always need to remember that past performance is not necessarily indicative of future results. If any of you would like to reach out to me, you can email me at rollie@tradingpub.com. And I also recommend that you take a look at our website at tradingpub.com, because we have a number of archived videos and webinars and things of that nature. They're all free of charge, and they are all available to you to go ahead and help you understand and provide you some information and some tips that might make it easier for you to make a decision as to what markets you want to trade and how you can be a little bit more confident and consistent in that endeavor. So from that perspective, that kind of wraps things up. I'm now available to answer any questions that you might have.